Listen, I want you to picture something. A Saturday morning in September of 2025, a kitchen in a ranch house in Tucson, Arizona. His name is Dennis. He is 63 years old. He took early retirement from a regional insurance company after 31 years in underwriting. He was good at math. He was good at probabilities. He spent 3 decades calculating risk for other people's policies, and he genuinely believed, that he had calculated his own risk correctly. Dennis has a traditional 401k with $740,000 in it. He has a Roth IRA with $88,000. He has a taxable brokerage account at Vanguard with $195,000. He has Social Security waiting at $70, projected at $3,900 per month. And he has 2 years until Medicare eligibility. 2 years of private insurance to cover before the federal program kicks in at 65. Dennis has a plan. He is going to let the 401k sit untouched and compounding for 2 years. He is going to live off the taxable brokerage account during the gap. He is going to wait for Medicare to start and then begin drawing from the 401k gradually to cover living expenses. He thinks the plan is elegant. He thinks the plan is disciplined. He thinks the plan is exactly the kind of thing a former insurance underwriter with 31 years of risk assessment experience would construct. He is wrong. Not about the elegance. The plan is elegant. He is wrong about what it costs. Because Dennis does not know that the moment he turns 65 and enrolls in Medicare Part B, the Centers for Medicare and Medicaid Services does not look at what he earned in 2026 to set his 2026 premium. CMS looks at what he earned in 2024, 2 years ago, the income from the year before last, the year he retired from the insurance company and received his final full salary plus the $180,000 lump sum payout, plus the severance, plus the accelerated vesting on the restricted stock units that settled at separation. His 2024 modified adjusted gross income was $347,000. Dennis is about to discover what happens to your Medicare Part B premium when your income 2 years prior was $347,000. He is about to discover IRMAA, the income-related monthly adjustment amount, and he is about to discover it not in a planning session with an advisor who modeled this in advance. He is about to discover it in a letter from the Social Security Administration that arrives in his mailbox in November of 2025, approximately 6 weeks before his 65th birthday, informing him that his 2026 Medicare Part B premium will be $628.90 per month, not the standard $185. Not even the first surcharge tier, the 5th surcharge tier, $628.90 per month, per person. His wife Ellen, whose 2024 income was elevated by the same deferred compensation event, also receives a letter. Her premium is also $628.90 per month. Together, Dennis and Ellen will pay $1,257.80 per month in Medicare Part B premiums in 2026 because of income they received in 2024 from a job Dennis no longer has. $15,093.60 per year for a program they have not even started using yet. For reference, the standard Part B premium in 2026 is approximately $185 per month. The penalty for being in the top IRMAA bracket is $443.90 per month per person above that standard. Dennis and Ellen will pay $10,653.60 per year more than a couple at the standard premium for the same Medicare Part B coverage. For the same policy, for the same network, for the same benefits. The only difference between Dennis and a retiree paying the standard premium is a number on a tax return from 2 years ago, a number that no longer reflects Dennis's income, a number from a job that ended, a number that will never appear on his return again. But IRMAA does not care about that. IRMAA looks back. IRMAA is patient. IRMAA collects the surcharge in the year you enroll, not the year you earned, and it does so with a 2-year lag, nearly invisible. Dennis was not watching for it. His financial planner never mentioned it. The HR department never mentioned it. The Medicare welcome packet never mentioned it. The Social Security Administration letter never mentioned it. Nothing mentioned it until the November letter arrived. Dennis sat down hard at the kitchen table and stared at the figure for a long time without saying anything. That is the IRMAA ambush, and it is the opening act of the 3-account conversion trap that we are spending the next 30 minutes dismantling. Because the IRMAA ambush is not just about what happens at age 65. It is about what happens every year after 65 when the 3 accounts, generate the income events that keep pushing him into surcharge territory year after year after year for the rest of his life. This is not a one-time hit. This is a structural, recurring penalty built into the architecture of his portfolio. And the fix existed. The fix was available. The 3 accounts that needed to be converted were sitting right there in Dennis's Vanguard and Fidelity interfaces for 2 full years before Medicare started. The window was open. Nobody walked through it. Smash the like button right now. I am not asking. The algorithm in 2026 is burying content like this. The financial services industry does not surface this analysis proactively. Because the Roth conversion reduces the assets under management and therefore reduces the fee the advisor collects. Every like on this video breaks the suppression. Every like puts this in front of one more 62-year-old. Hit the like button, subscribe, flip the bell, join the archive because this is a series. And the next installment covers the IRMAA interaction with required minimum distributions. It compounds. The suits in legal want me to say this is not financial advice. Fine. This is not financial advice. This is a forensic examination of how a 2-year look-back mechanism interacts with 3 specific account types in a way that generates a recurring annual surcharge that can cost a retiree between $10,000 and $25,000 per year per couple. Consult a fee-only fiduciary. Consult a CPA who understands modified adjusted gross income calculation. What I can do is show you exactly how the mechanism works and what 3 accounts need to move before age 65 to prevent it. Let me start with the statutory architecture. IRMAA was created by the Medicare Modernization Act of 2003 and expanded by the Affordable Care Act of 2010. It is codified in Title 18 of the Social Security Act. The statute directs CMS to determine Medicare Part B and Part D premium surcharges based on modified adjusted gross income from the tax return filed 2 years prior to the premium year. The 2-year look-back is not a design flaw. It is the only administratively practical option available to CMS, because the IRS does not finalize tax return data until well after. The 2026 Medicare premium is set using 2024 tax return data because 2025 data is not yet available. The look-back is a structural feature of the administrative system, but for a retiree, it is a trap. Here are the 2026 IRMAA brackets as they currently stand. For a married couple filing jointly, the standard Part B premium applies below $212,000. The first surcharge tier begins at $212,000, adding approximately $74 per month per person above the standard premium. The second tier begins at $266,000, adding approximately $185 per person per month. The third tier begins at $334,000, adding approximately $296 per person per month. The fourth tier begins at $402,000, adding approximately $407 per person per month. The fifth tier applies above $750,000 of magi and adds approximately $444 per person per month. For a single filer, every threshold is exactly half of the married filing jointly number. The bracket structure is a cliff, not a ramp. Crossing the $212,000 line by $1 triggers the entire first-tier surcharge for the full year. There is no proration. There is no partial surcharge for being slightly above the threshold. You are either below the line or above it, and the premium difference between those two positions is $1,776 per person per year at the first tier. The IRMAA determination also applies to Medicare Part D. Surcharges in 2026 range from approximately $13 per month to $81. A couple in the fifth IRMAA tier pays Part D surcharge, which adds another $162 per month on top of the Part B impact. The combined annual IRMAA surcharge for a couple in the fifth tier in 2026 is approximately $12,613, above the standard premium. For the same Medicare coverage, a standard premium enrollee receives. Now let me name the 3 accounts that feed the IRMAA machine. Account number 1, the traditional 401k or traditional IRA, with a balance large enough to generate significant income on distribution. Every dollar distributed from a traditional 401k or traditional IRA counts as ordinary income and enters the modified adjusted gross income calculation. There is no exception for distributions used to cover medical expenses. There is no exception for small or one-time distributions. There is no exception for distributions that come from required minimum distributions the retiree did not voluntarily choose. Every dollar is income. Dennis's situation before we identified the problem. He has $740,000 in his traditional 401k. He turns 73 in 8 years. At 73, required minimum distribution is approximately $27,925. If his account has grown to $900,000 by then, the RMD climbs to approximately $33,962. Kenzo after 60 style. Stack that against his Social Security of $46,800 per year. Kenzo after 60 style. His combined income in the RMD years is approximately $80,762 before any other income sources. Kenzo after 60 style. But here is where the cascade begins. Dennis has a taxable brokerage account throwing off dividend income every year. He has CD interest. Kenzo after 60 style. Every additional income source stacks on top of the 401k RMD and pushes the MAGI higher. That single-year spike can push his MAGI across the IRMAA threshold, Kenzo after 60 style, and generate a surcharge 2 years later that has nothing to do with his actual income in the surcharge year. Kenzo after 60 style. The fix is Roth conversion executed before age 65, during the years when MAGI is at its lowest point. Kenzo after 60 style. For Dennis, those years are ages 63 and 64. His ordinary income is low. Kenzo after 60 style. His salary is gone. His deferred compensation was paid out. His RSUs settled. The Roth conversion window is open. Kenzo after 60 style. In 2025, his projected MAGI is approximately $68,000 for the couple. Kenzo after 60 style. The IRMAA threshold is approximately $212,000. Dennis has $144,000 of MAGI headroom before triggering the first IRMAA tier in 2027. Kenzo after 60 style. He could have converted up to $144,000 in 2025 while staying completely clear of the IRMAA threshold. Kenzo after 60 style. The federal income tax on $144,000 would have landed primarily in the 22% bracket. Kenzo after 60 style. Tax on the conversion approximately $25,000. He pays $25,000 in tax in 2025. He moves $144,000 from the traditional account to the Roth permanently. Kenzo after 60 style. That $144,000 in the Roth will never generate a MAGI event. It will never feed the IRMAA machine. It will never trigger the 2-year look-back penalty. Kenzo after 60 style. He repeats the exercise in 2026, converting another $100,000 to $140,000. Kenzo after 60 style. 2 years of strategic conversion. $250,000 to $280,000 moved from traditional to Roth. Kenzo after 60 style. And the remaining traditional 401k balance, reduced to approximately $470,000, generates proportionally smaller required minimum distributions. Kenzo after 60 style. Smaller RMDs mean lower MAGI in the RMD years. Lower MAGI means lower IRMAA surcharges. Kenzo after 60 style. The conversion Dennis did not do would have produced a cascade of MAGI reduction that protected his Medicare premium for 15 to 20 years. Kenzo after 60 style. The conversion he did not do will instead allow the traditional account to grow, generate larger RMDs, and produce recurring IRMAA surcharges. Kenzo after 60 style. Tell me in the comments right now. Tell me your age. Tell me the approximate balance of your traditional IRA or 401k. Kenzo after 60 style. We will calculate your IRMAA exposure and your conversion window together in the comment section. Drop the numbers. I read every single one. Kenzo after 60 style. Account number 2. The rollover IRA holding an old employer's 401k that was transferred in during a job change and has been sitting untouched ever since. Kenzo after 60 style. This is the silent IRMAA account, the one most retirees forget about because it was built passively, transferred automatically. Kenzo after 60 style. The rollover IRA carries the same tax treatment as any traditional IRA. Every dollar distributed is ordinary income. Every dollar enters the MAGI calculation. Kenzo after 60 style. It is not treated more gently because it holds old money from a job the retiree left in 2003. Kenzo after 60 style. To the CMS algorithm, a rollover IRA distribution is income, period. Kenzo after 60 style. First, the pro rata rule under Internal Revenue Code section 408. Kenzo after 60 style. The IRS requires you to treat the conversion as coming proportionally from all your IRA balances combined. Kenzo after 60 style. You cannot designate which dollars are converted. The conversion is prorated across the entire IRA universe. Kenzo after 60 style. A retiree with $500,000 in a rollover cannot simply convert, tax-free. The rollover IRA contaminates the conversion. Kenzo after 60 style, either converted directly to Roth or rolled into an active employer 401k plan. Kenzo after 60 style, which removes it from the IRA aggregation calculation and allows cleaner backdoor Roth conversions. Kenzo after 60 style. Second, the rollover IRA is subject to required minimum distributions beginning at age 73, aggregated with all other traditional IRA balances. Kenzo after 60 style. The rollover IRA does not get its own separate RMD treatment. It gets lumped into the total. Kenzo after 60 style. And the total generates the forced distribution that feeds the IRMAA machine. Kenzo after 60 style. In most cases, the conversion cost is dramatically lower than the lifetime IRMAA surcharge. Kenzo after 60 style. Account number 3, the high-yield taxable savings account, the certificate of deposit portfolio, Kenzo after 60 style, generating annual interest income that appears on a 1099-INT or 1099-DIV every January. Kenzo after 60 style. This account is not a retirement account, but it is the third account that feeds the IRMAA machine. Kenzo after 60 style, because every dollar of interest counts as magi at full face value, 100 cents on the dollar. Kenzo after 60 style. No deduction, no deferral, no shelter of any kind. Directly into the modified adjusted gross income calculation. Kenzo after 60 style. A retiree with $300,000 in CDs earning 4.5% generates $13,500 of interest income. Kenzo after 60 style. That $13,500 stacks on top and is the marginal amount that pushes them across the line. Kenzo after 60 style. The surcharge on crossing the first IRMAA threshold for a couple is $3,552 per couple per year. Kenzo after 60 style. The effective cost is $2,970 in direct income tax plus $3,552 in annual IRMAA surcharge. Kenzo after 60 style. A 4.5% CD became a 2.3% CD because of an IRMAA interaction that the banker never mentioned. Kenzo after 60 style. Variant 1. Replace interest-generating taxable bonds and CDs with tax-managed equity index funds. Kenzo after 60 style. The gain is only recognized when the fund is sold, giving you control over the timing. Kenzo after 60 style. Variant 2. For retirees with charitable intent. Redirect interest-generating taxable account assets into a charitable remainder trust. Kenzo after 60 style. Directs up to $105,000 per year directly from the IRA to a qualified charity. Kenzo after 60 style. That distribution satisfies the required minimum distribution without entering MAGI. Kenzo after 60 style. The QCD is simultaneously the most tax-efficient giving mechanism and effective IRMAA reduction. Kenzo after 60 style. Variant 3. In states with significant income tax, consider municipal bonds. Kenzo after 60 style. Interest is exempt from federal income tax under Internal Revenue Code section 103. Kenzo after 60 style. However, tax-exempt interest is explicitly added back into the provisional income calculation. Kenzo after 60 style, but it does not enter the modified adjusted gross income calculation for IRMAA purposes. Kenzo after 60 style. The muni bond pivot is a cleaner IRMAA solution for the taxable savings account. Kenzo after 60 style. The cost of the 3-account restructuring strategy varies enormously by state. Kenzo after 60 style. In Florida, there is no state income tax. Florida is therefore the most favorable state. Kenzo after 60 style. Every dollar of conversion tax saved by Florida's lack of state tax is a pure bonus. Kenzo after 60 style. The conversion still makes sense if the IRMAA surcharge it prevents exceeds the additional state tax. Kenzo after 60 style. In New York, a New York retiree pays a combined marginal rate of 28.85%. Kenzo after 60 style. In Texas, like Florida, there is no state income tax. Texas retirees are operating in the most cost-efficient environment. Kenzo after 60 style. In California, a California retiree pays a combined 31.3%. The conversion cost is the highest. Kenzo after 60 style. But California also has among the highest Medicare surcharge costs. Do not assume conversion is wrong. Kenzo after 60 style. What you are doing in the next 30 days, the next 6 months, and the next 2 years. Kenzo after 60 style. Step 1. Calculate your current and projected MAGI for each of the next 5 years. Kenzo after 60 style. Map each year's projected MAGI against the IRMAA threshold for that year. Kenzo after 60 style. Identify the years where a large discretionary distribution ... could push you across. Kenzo after 60 style. Step 2. Identify the maximum Roth conversion amount without crossing an IRMAA threshold. Kenzo after 60 style. Subtract your projected MAGI. The difference is the maximum conversion amount. Kenzo after 60 style. Step 3. Execute the conversions in the identified amounts each year. Do not wait. Kenzo after 60 style. Each year of inaction compounds the IRMAA problem. Each year of conversion reduces it. Kenzo after 60 style. Step 4. Reposition the interest-generating taxable account assets to reduce their MAGI. Kenzo after 60 style. Calculate the MAGI reduction and map it against the IRMAA threshold. Kenzo after 60 style. Step 5. Establish an IRMAA appeal protocol for income events that were one-time. Kenzo after 60 style. The Social Security Administration has a formal appeal process called the Life-Changing Event Appeal. Kenzo after 60 style. You can request that CMS use a more recent year's income rather than the 2-year look-back. Kenzo after 60 style. Dennis could have filed an SSA 44 appeal using retirement as the qualifying life-changing event. Kenzo after 60 style. The appeal is the fastest path to restoring the standard premium in the current year. Kenzo after 60 style. Save this video to your private library right now. Add it to the Retirement Survival playlist. Kenzo after 60 style. Because the IRMAA interaction is a recurring annual calculation that will follow you. Kenzo after 60 style. Operating silently until the Social Security Administration letter arrives in November. Kenzo after 60 style. The letter will not explain itself. It will not tell you which income event triggered the surcharge. Kenzo after 60 style. Dennis is now working with a fee-only fiduciary to model the damage. Kenzo after 60 style. The 2026 premium is locked, but every premium after that is a product of intentional income positioning. Kenzo after 60 style. He is now calculating his own with the precision the situation demands. Kenzo after 60 style. The surcharge will come down. The traditional account balance will shrink. Kenzo after 60 style. The RMD projections will be smaller. The IRMAA exposure in his 70s will be manageable. Kenzo after 60 style. Subscribe if you have not. Flip the bell. We calculate the IRMAA exposure together. Kenzo after 60 style. The Medicare premium surcharge was designed for the retiree who does not model their income. Kenzo after 60 style. Model it. Convert what you can. Reposition what you must. Kenzo after 60 style. Do it before the November letter arrives with a number you were not expecting. Kenzo after 60 style. Because that letter is not the beginning of the problem. It is the bill. Kenzo after 60 style. I will see you in the next one. Stay strategic. Stay furious. Kenzo after 60 style. Turn the lights on. Run the math. Stop feeding it. Kenzo after 60 style. Tax on the conversion approximately $25,000. He pays $25,000 in tax in 2025. Kenzo after 60 style. The RMD projections will be smaller. The IRMAA exposure in his 70s will be manageable. Kenzo after 60 style.